I'll trim it.
So I just want to welcome everybody. Thank you for coming to our Homebuyer seminar. Here are Joe and Sunny Tribble with Tribble Property Group. And our main goal here today is to give you information about the home buying process and to answer any questions that you might have. This is going to be kind of a good overview of what it looks like. And we also have professionals here for a loan officer and insurance specialist to also, answer those questions too. So, Bart?
Yeah, my name is Bart Maldonado. I'm with Supreme Lending. I think Sunny, mentioned part of what we all do together when we're working with first-time home buyers is really we're a team. And so that's what one thing is that we do is I'm the money guy. Most people, unless you have big piles of cash, which I know I don't have, and lending is part of the process of figuring out how to take your current finances and then find a home that we can all work together on for you. So.
Absolutely. And my name's Evan Gibson. I know I got to meet everybody kind of walking in. It's great to meet you. I'm the owner of Gibson Insurance Solutions, and kind of my, tactic as far as first-time home buying is concerned is I'm really just a part of these guys' team. I'm working directly with Bart on the loan because insurance is a thing that you're going to need on the loan when you close it. It's actually a requirement, which I'm sure they'll touch on. Making sure that you've got the correct amount covered for your loan, but also so that we can rebuild the house. And I take a full scope view of everything. Walking with the client as they come through with Sonny and Joe. Really just, I'm kind of the guy that stands behind everybody and makes sure everybody's protected. Make sure his loan is protected, making sure their client is protected, and ultimately it's all about relationships. So that's what I'm here to do is help with that. So
Okay.
Great to be here.
And Evan will come in a little bit more towards the end of this, just to kind of touch base. Actually, the whole last part is his, so we're giving it all to him then. So, what we want to let you know is buying is all about you. We're here to be your guide. We're here to work together as a team. We are here for you. We're here to protect you. We're here to listen to your concerns. We're here to manage your transaction to the end and make sure that you actually get your dream home. So, one of the things we wanted to touch on is that owning a home, why buy one? Why not rent for your life? So, homeownership is a form of forced savings. It makes you pay attention to your financial life, make sure that you are paying everything on time, and it's putting money away because you're appreciating it. We'll touch more on that too. Provides tax savings. If you do or do not know, when you're a homeowner, you can write off some of your mortgage interest depending upon your loan. When you lock in your monthly cost of your home, basically that is, your payment and interest. You know what that is. It's not like being in a leased, apartment or house where that can change every time you sign a new lease. They can raise that on you. That does not happen. Buying a home is less expensive than renting. Again, money to get into it. The costs keep going up with renting. That kind of comes into it as well. And then, owning a home is the only investment that you have that really appreciates all the time. You buy a car, that depreciates. You own it, but it depreciates. So that's where you're actually gaining your income, your financial security is from owning a home. So studies have shown that a homeowner's net worth is 44 times greater than that of a renter. And that is because as you're gaining that equity, that helps you in all levels of your life financially in that equity build. And then the median price home that started in 2019 would build more than $37,000 in wealth over the next 5 years with a projected appreciation rate. So that's good money in the bank when you come to it. Or if you buy the next one. So this is a great slide, I think, for you to note that the income that's needed to get into as for median rent versus median home right now, not even the historical, but the right now, 27.7% of your income is generally needed on average versus a home, 17.5%. Huge savings there. So, steps. If you're wanting to know how to do this, We're here to kind of, this is what we're here for, to kind of guide you through that. So the first thing is get pre-approved for a mortgage before you start your search. Bart is going to kind of speak on that a little bit. And choose the right real estate professional. That's us. We're the right ones. And it's because we do feel that way, because we do care about our clients and we do work together as a team. And that's one of the reasons we're actually putting this on to give this information to people. So one of the things is knowing the difference between your must-haves and what you would like to have. Part of that is your budget, but that is working with a professional, because we will discuss with you, what's realistic for you, for your must-haves, and what would you like to have. And sometimes we can make the like-to-haves happen. And then we'll help you research and choose a neighborhood where you want to live. Again, that's all discussion with, what's important to you, and then pick the house style you love. That all kind of comes into play with working with us, where we can make that process easier for you than going to every open house or searching through hours on Zillow. So that's important too. So I'm just going to briefly say there is two differences when it comes into the mortgage process and getting pre-approved or pre-qualified. Bart is our expert on that, so I'm going to let him speak on that.
Cool. So in the end, the most important part is what is pre-approved, what is pre-qualified, what does that mean? Why is that so important that you don't just jump on Zillow and start finding all the homes that you start clicking everything and fall in love with the home that you want to buy? And the reason why is I think that understanding, it's something I remember when we bought our first home, and so I think understanding, what your finances look like. What are your finances? How do they pertain to the amount of loan that you can get that you can get approved for? And that way you stick within realistic expectations. And I think a lot of times we'll find that people will find a home, they'll love it, and then maybe their finances aren't necessarily ready. And so it's one of those things. We do a combination of bringing clients to each other at specific times, but in the end, and that's why a lot of agents, they want to have someone that's pre-approved before they really look at houses. And the reason why is that way, they can really dedicate their time to finding you the best house that you can afford. So we're all living with realistic expectations. In the end, nobody likes falling in love with something that in the end the numbers don't work, and that's the most disappointing when we have someone who loves a house and they're ready to put an offer in, and then after about a day of doing work, they realize that they can't afford the home that they want. And so it's always important to take that first step, which is why we encourage you to do that. So basic information regarding customer stuff. So the different things that you want to look at when it comes to getting pre-approved. Okay, obviously, so basic income. Everything runs off of. I would say I tell a lot of my lenders that I'm working with and I'm teaching that income is really the building block foundation for everything. It is. It's your income and your employment, and one begets the other. So employment, we're basically looking for about 2 years of consistent employment. It doesn't have to be the same job, but it's better. It's best for it to be within the same line of work. But really, it's more about your pay structure. So if you go from being a self-employed individual to then being an hourly person, an hourly paid, or being salary, and all those things those really matter. So income is number one. So employment, and then begets income. And keep in mind that when we're looking at all the different factors that a lender looks at, as far as whether or not you can get pre-approved, always have this word blinding above you. It's the word risk. Okay, so what a lender does is they use all these different factors to measure the risk of giving you a bunch of money to buy a home, and whether or not that you are most likely to repay that and not go into foreclosure and forbearance, foreclosure or short sale or anything like that. I mean, everybody knows that movie, The Big Short, that came out a couple years ago, right? Well, that's actually a relatively accurate picture of what happened. And basically, the world of mortgage lending in the U.S. was very non-regulated for years, actually for its entirety. And then all of a sudden, everybody really took advantage of that. And all of a sudden, foreclosure rates started climbing, and then obviously, it almost caused the entire economy to collapse. And so, a lot of what is now, what we can and can't do, is now very heavily regulated by the U.S. government. And so that's why it's so important to kind of get all this stuff, as far as what we can use and what we can't use. And a lot of that stuff, they're just rules. Every lender plays by those specific rules, and I tell a lot of clients what we can and can't do. If one lender says they can do it, they can't. It's very rare that usually the way that service and interest rates are really where lenders really compare to each other. But as far as what they can and can't are allowed to do, a lot of it comes down to basic to knowledge of the person that you're speaking with. So, All right, so we go income, monthly debts, credit history, and assets. So credit history, basic credit history is this. We're typically looking for a 620 and above, but it's beyond just a credit score. Okay, it's also the depth of your credit. How long you have credit lines open? Do you have what are called derogatory issues when you in your past credit? And just because you have credit issues doesn't mean you can't get approved. It just means that we have to be able to work through that stuff. Late payments, bankruptcies, foreclosures, short sales, anything that is in dispute. All these little things that we look at. I spend on average with every new client, I spend about a good hour reviewing the credit report. It really does. It tells the story of your life, of your past 5 years. Sadly enough, your finances actually tell a pretty solid story of what's going on in your life, and I can see kind of what's been going on, and then we work through that. I tell people all the time. I think the thing that always kind of puts a funny smile on my face is when people will apologize for their credit score or their credit report. That's my job. Our job is to work together as a team to use the information for each individual client and then navigate through that situation so we can get to the end result, which is it's not to judge anybody. It's to find you a home. That's what we get. If we don't find you a home, then we're not doing our job. So, and then assets. Of course, assets meaning, and it's not like do you want a boat. It's more it's some liquid assets. So cash mainly. So checkings, savings, retirement, Social Security, child support, alimony. All these are all different forms of what are called calculated or qualified income that we can use to get you qualified. In the end, income and employment, it's to show stability. And stability is probably, when it kind of goes back to what I was mentioning before, is risk. So stability of employment and income, it lowers that risk factor. So the more income, the longer you've had a job, the more stable that income looks like it's going to continue. Therefore, you lower that risk factor, which makes you more approachable and more desirable to get approved for a loan. That makes sense. All right. What is the major difference between a pre-qualification and pre-approval? The biggest difference is this. We do a pre-qualification. It's a basic loan application that reviews employment, that reviews credit, income, basic assets, and also anything that you currently own. You look at those basic things, and then there's a bunch of numbers, and those numbers we basically run through an artificial intelligence machine is the best way to put it. And it tells you whether or not that we, according to federal guidelines, this is a relatively safe loan, or if there are things that we need to overcome, we can do that within a specific time period when you're looking to purchase. So then we issue a pre-approval letter. A pre-qualification. So then a pre-approval would be once you get under contract and we collect all that data, we start verifying all that information. We start verifying all your income. We start verifying the dates, the different places that you've worked, any issues with credit. If you paid something off, we verify that stuff and how it affects all those things. So that's the major differences. The first one is like, hey, we're pretty sure this is going to work, and then the second one is, all right, yeah, this is going to work. We're going to make it happen. So that's the best way to put it. All right, pre-approval myths. How to make things less scary. I already know what my credit score is. All right, so the weird part of the mortgage world, like any other business, is the U.S. government, as a way to make you come to me, basically, is the best way to put it, is you can't actually see what your real true credit score is. What you see online, they're called commercial credit scores. So you'll see Credit Karma through your bank FICO scores. That's a really good range of where your credit score most likely is. Usually if you're using your bank app, you're going to see one of the 3 credit bureaus, or sometimes 2 of the 3 credit bureaus. So what a mortgage lender does is a mortgage lender is going to take all 3 credit scores, and they're going to take your middle score. Now, if there are 2 people in a loan, so let's say, for example, both of you, whoever had the lowest middle score, that's whose credit score that we would use for that specific loan. Keep in mind, now when it comes to credit, that mortgage credit scores are going to be more stringent and tighter than your commercial credit scores that you're going to see on Credit Karma. And the reason why is obviously it's as simple as the risk factor is greater. The risk factor is greater with hundreds of thousands of dollars that you're lending on a home versus $3,000 you're trying to get on a credit line extension, or a $5,000 couch you're trying to purchase. Does that make sense? So when there's more money, there's more risk. So as there's more risk, the factors that create those scores are more stringent. And that's why it's the first thing when I mention to people, I'll ask them, I say, do you have an idea of what your credit is? And for example, I mentioned before that you need to be at about a 620. So if somebody says, I'm about a 622, when I pull your credit, it's probably going to be about a 590, which means we may have a little bit of work to do before we can get you qualified. Somebody says they're an 815, I go, awesome, next, which is great. But so that's kind of where that credit score myth comes in. But I don't want to discourage you because there is no way to pull your mortgage credit scores unless coming to a mortgage lender. But I don't want you to discourage you from tracking your credit because it's important to have a ballpark range of where you're at. If you pull your credit and you've never pulled it before and it's a 500, you got some work to do. And that's okay because as I tell a lot of clients, you have to know where you're at so you can know where you're trying to go. So, all right, your credit score. I think we just talked about that for the most part. And then every time my credit is pulled, I take a hit. The U.S. government, it's called the Consumer Financial Bureau, is the best way to shorten it. But basically, it's a big department that the Obama administration brought into the U.S. government that manages mortgage lenders, and they are very much about the consumer. It's about the consumer and the consumer's rights. So, as a way to benefit the consumer, they put a law into place in 2012. That means when you have a mortgage lender pull your credit score for the very first time for the purpose of purchasing a home. The inquiry will show on your credit report, but it will not negatively affect your credit report. You have 30 days from the initial pull to have your credit pulled as many times as you want for mortgage purposes, as a way to be able to actively shop different lenders at different rates. So it allows you the ability to be competitive as opposed to getting your credit pulled 15 times so you can look at a bunch of different lenders, and then every time you do that. So before. People would be like, they'd be really hesitant, and then finally when they say they pull the trigger, they felt they were married to that lender, whoever pulled their credit for the first time. So the government did away with that. It's a big myth. A lot of people think that every time that your credit gets pulled for mortgage purposes, like let's say the first person, they didn't like the person, they didn't really like what they were saying, the rates were high, they were disorganized, the person was bad with communication, and so then they want to come to me, and then I say, hey, we're good with communication, our rates look great, everything's awesome, I'd love to work with you, and they're afraid of me having to pull their credit because they don't want to get dinged. So we have that conversation. But in general, I'll tell people that even if you're past that 30 days, it really, inquiries, it all depends on how many inquiries as a whole you've had within a 6-month time period. And then more importantly, it really has to do with the body of your credit. If you have 10 credit cards and 3 loans, you have a lot of credit history, an inquiry, a couple of inquiries is not going to do a lot. It's really, and that's where the personal relationship with what we do really comes in, because then I can say, hey, how many credit lines do you have? Oh, we have 1 credit card and it's only been open for 6 months. Yeah, the inquiry is going to sting a little bit if we don't do it within that 30-day time period. So, but yeah, as far as in general, like everybody thinks that a hard pull is going to send their credit like plummeting and then they won't get approved, and that's not the case.
So this kind of goes to what you're talking about. So most people think they need 20% to put down on a home. That is not the case at all. In fact, very rarely, right, do people actually have 20% to put down. And I actually love this graphic too because it actually shows like the majority of people actually put down 5% or less. And they're very doable.
Yeah.
Programs.
Yeah, I mean, what I constantly say to clients when we talk to them for the first time, and for you guys, just tell us what you want to do. Some people are like, should I put 20, 10? And then all of a sudden, I'll have people that will start with 20, and then all of a sudden, like, I can get home and put 3% down. I'm like, yeah, oh, let's do that. Sure. In the end, keep in mind that with the mortgage and with what we're doing with the home, the same thing with the home that you purchase. Excuse me. Everything that you do, whether it goes one way or the other, there's benefits and there's positives and negatives to everything. If you put 3% down, you have more money in the bank, so you can furnish the home and get moved. But then in the end, your mortgage payment is going to be higher. Then if you put 20% down, you may not have as much money to make the move, but then you're going to have less interest and you're going to have a lower payment over the life of the loan. So it's all, in the end, we all work together to listen to you and say, hey, this is what you have. And either you know exactly what you want, and what you want is what works, or you say, this is what I want, and then we say, maybe there's a different way to look at this. Have you thought about it this way? And that's where all three of us connect. So.
Right, and the whole point is working together on that. We can kind of help strategize what is best for your situation at that time. So this is definitely
absolutely. So barriers. So we mentioned a lot of this stuff already before, but so barriers. Number one is low credit. So I always say the 3 C's. As you can tell, I talk fast, which is something I try to often monitor. But sometimes I'll catch somebody on a lunch break, or I can catch somebody there at their office and talking like this, but they really want to talk to me because they want to buy a home. And they don't know what they're doing, and they can't talk at night. So then we have this conversation in whisper mode because they're at their cubicle. All right. So sometimes I have to be able to get in and get dirty really fast. Hey, let's rip off the Band-Aid. What does it really take to purchase a home? So then I go to the 3 C's. So credit, your history of paying bills and other debts on time. You have to have a usable credit score. We can do low score loans between the 580 and 619 range. They are a gigantic pain in the booty. Okay, they're not fun. Unfortunately, the FHA, which runs those programs, has not made them advantageous to the person who needs that style of loan. It's like these weird anomalies. So I very rarely do those loans, but they do exist. In general, though, 620 and above is what you're looking for. So 620 to 700 is going to be mainly your FHA loans, and then your conventional will be about 700 and above. The main difference between an FHA and conventional loan we'll cover in a few minutes. But credit is important. You have to have, the very first thing, every lender can tell you they don't do this, but they'd be lying to you. The very first thing we do is we pull credit. Because if you have below 620, then all the rest of that stuff doesn't matter. The amount of down payment, the amount of, your bills and your income, none of that matters. We can't play ball and get you into a loan program if we don't have an acceptably usable credit. And if we have a 618, sometimes, that's, for me, my threshold is usually about 580. If I pull someone's credit and they have a 580, then I really dig into their credit report. We have simulators, we have different, basic different tactics. I read about 100 credit reports a month. So I've seen everything. And so then we use that and that knowledge in those simulators, and we also have a partner company that we work with that we can bounce ideas off of. Are we a credit repair company? No, we're not. But if you've got a 580 credit score, then there's usually good reason to believe that I can, within a specific amount of time, we can give you guidance on how to do that. And sometimes it's as simple as, hey, did you know that your Discover card had a late payment on it? I didn't know that. Cool. You've never had a late payment on it ever, have you? No, you've had that card for 10 years. Give them a call. It was a mistake. Well, you just forgot or something. You paid it 1 day late. Give them a call, see if they'll wipe it off. Most of the times they will. And then all of a sudden your 618 credit score, when you only have 2 trade lines, your 618 credit score shot to a 700 in less than 3 days. I see it all the time. So credit is a big important. But more importantly, if you don't know where your credit's at, you have to let us dive in, because I can look at a credit report and tell you, hey, this is what's causing you pain, and this is going to be 6 months, this is going to be a year, this is going to be 3 months. Until we can get there. So capacity, your current and future ability to make your payments. So capacity goes into one really very broad acronym because it involves tons of different links, but it's called debt to income ratio. And it's exactly what it sounds like. You take your debts, and in a mortgage world, your debts are going to be your proposed mortgage payment, plus any credit card debt that you have, and then also any installment debt, student loans, car loans, personal loans. Those. Your cell phone bill, we don't care about. Your electric bill, we don't really care about. So loan debt, credit card debt, proposed mortgage payment. Those create your debt, and then you divide that by your monthly income. Use a gross number. So for example, a couple, what does a husband make a month on average? What does a wife make a month on average? Okay. So then, and that gives us a ratio. So FHA ratios are like a 55. Conventional loan ratios are about a 45 to 47. So as we start getting all this information together, then that's what really clarifies. A lot of times people will call me and say, here's my information. And I say, hey, well, how much home are you looking to get? I don't really know. Can you just run it through and tell me what you think? Cool. I usually start at 200 and then we go up and down from there. And that's okay. If the answer is, hey, I don't know. Tell me what I can afford. And that's good. And I know people be blunt with me, like, I want to get a $500,000 home, but you only make $12 an hour and you only work 30 hours a week. The math is just not there. But in general, it's really important with capacity and the debt to income ratio, because when we have problems, we kind of go back to the word debt to income ratio. If that number is too high, then we either have to find a way to bring more income in, we have to find a way to bring debt down, like by paying off bills, or there's other ways to structure those things, or then we need to reduce the sales price and increase the down payment, because those lower the monthly payment, the loan amount. It's really the loan amount that that sets that number. So. All right, and then cash. You gotta have cash. There are down payment assistance programs. Sonny and I were having this conversation before. Even the down payment assistance programs, I would say the minimum amount of cash that you need to have to make anything happen would be about $2,000, unless you're buying an insanely expensive house, which most people don't do when they're under down payment assistance area. But I would say about $2,000 in cash, because Sonny's going to talk about some things you need to have that cash for. Basic stuff. It's really simple. FHA. 3.5%. So if you have a lower credit score under 700, think about 3.5% of the sales price is what you're going to need for down payment, and then a conventional loan with a higher credit score of 3%. Okay? Now there are down payment assistance programs, which we'll talk about a little bit later. But yeah, as simple as that's your down payments. 3.5% for FHA, 3%. And sometimes people don't know that that's the case. And those are minimums. Loan types. So that kind of leads me to the next one. Yeah. So all these kind of leads together. So loan types: conventional, FHA, USDA, VA. We'll knock out the two easy ones that are easy to go with. Jumbo. Yeah. Jumbo's
Probably not first time home
yeah,
buyer.
first time home buyers, jumbo. The reason the jumbo there was a loan limit in the United States, and it changes every year. So the conventional loan limit is 510,400. Usually not your first time home buyer. Jumbo loans people usually try to stay away from because they take longer to process. The interest rates are higher. They have to be double underwritten. They are not the easiest to maneuver. So I complain that world, but I don't usually. Then the VA and USDA. VA is really easy. You have to be a veteran. It's a great loan program because the down payment's covered. It can't be your mom. It can't be your dad. The only a veteran and a veteran's spouse, legal spouse, not common law spouse. A legal spouse are the only people that can be on a VA loan. For example, on a conventional loan or an FHA loan, if me and Evan were just friends and we were buying a house together, then we could do that. I did a loan this week. I closed for two brothers. But you have to be a married couple to use the VA loan. One of them has to be a veteran, and a veteran that was honorably discharged. Okay, if you were court-martialed, kicked out of the military, it's not going to work. So. And then USDA. USDA is there are two major guidelines or barriers to entry, as I call it, for USDA loans. The first one would be your income. It's about $100,000 is where. So a combined couple or individual under $100,000, you would qualify for USDA loan, depending on what county. Other sorts of maps that we just plug your information into that specific zip code. And then the biggest thing would also be with the zip code would be does that area qualify for you is on the USDA map. Anybody can just literally go to USDA loan map, and then it pops up and it tells you if that zip code is a USDA loan map or is a USDA area. I have a client today that was in the USDA loan. I don't do those all that often, but the cool part about a USDA loan is it's just like a VA. It's 100%. They're called 100% financing loans, which means the down payment is covered. So the only part that you have to come to the table with as cash would be obviously the closing costs, and then of course if your wonderful, fantastic agent gets the closing costs covered by the seller, then the lowest amount I've ever had a person close on is at the table they got a check for $600 back. So technically it cost them nothing to get it. Doesn't happen. So the bigger ones are FHA and conventional. Kind of mentioned some of the major differences. The big difference is a magical word called mortgage insurance. So mortgage insurance is exactly what it sounds like. Remember what I've always talked about, that it's like your risk. It's your risk factor. That's what a lender looks at. So with mortgage insurance, it's as simple as the FHA has a mortgage insurance premium that's charged up front. It's part of your loan amount. So if you have a lower credit score, the FHA, you have this like mortgage insurance amount that gets charged based off the sales price. So it's 1.75% of the sales price. That is a fee that gets added on to your loan amount. And then also there's mortgage insurance that you have every month that's part of your monthly payment. Okay? So with a conventional loan, if you put less than 20% down, you will have mortgage insurance, but during the life of the loan, it will go away eventually. With an FHA loan, the mortgage insurance is always there. What does that really mean in actual terms? It means that with an FHA loan, you will get less house for the money than a conventional loan. As simple as that. Your $200,000 home will cost you more over the life of the loan for an FHA loan than it will for a conventional. And that's not 100% fact, but that is for the most part what it kind of boils down to. Is you can get more home if you have a higher credit score. You can qualify for a conventional loan as opposed to if we have to go FHA. FHA is specifically meant for people who have higher credit scores that are usually first-time home buyers. It's a great program. Our first home is on an FHA program. Okay? But in general, conventional is better because the rates are usually better. But more importantly, you have to put less money down because remember, conventional is 3% minimum versus FHA, which is 3.5%. All right. Loan programs: 100% financing, down payment assistance, HELOC. I don't do HELOC, so don't worry about that right now. HELOC is a home equity line. We won't worry about that right now. So down payment assistance, 100% financing. There are FHA 100% financing loans. There are conventional 100% financing loans. When you do a 100% loan with either a conventional or FHA, there's two loans. The first one is the base loan. Okay, so for example, with an FHA, because the minimum is 3.5% down, so your first loan will be 96.5%. The second loan is 3.5%. The loan program, the FHA program that I like the most, has only been available for about a year, and it's actually cool. So you have the 96.5% loan that we give you. The second loan, the 3.5% of the down payment, it gets covered. It's a second loan, but that second loan just sits there. It just sits there and doesn't do anything. No interest payments on it, no principal payments on it. It just sits there. And if you pay the first loan on time for 3 years, that second loan that just sits there the whole time, it gets forgiven by the U.S. government. It's really cool. And that's a great program. Now, with all down payment assistance programs, like anything else in the world, nothing is free. There's always a catch to everything. So the down payment assistance programs, they are specifically meant for people, whether they're like higher credit score people, conventional, lower score credit people, FHA. The caveat is the interest rate is higher. So you usually have, right now the average interest rates between FHA and conventional, we're looking like a 3.75 and a 4, okay, to be conservative. And so for an FHA DPA program or the conventional DPA program, they're going to be about like a 5.25. So is a 5.25 much higher? Absolutely. But keep in mind that the reason why Sonny and Joe use us and use people that they trust is you can do everything online, but a lot of people, they need help navigating through this process. What's best for me and my wife? What's best for our family? What's best for me as an individual buyer? A lot of these loan programs, people don't know they exist. And really, keep in mind, there are three parts to every mortgage deal. There is the interest rate, there is the mortgage payment, and then there is the cash to close the deal. And so, what of those three things are important to you as a family? What is the most important thing? Of course, everybody wants the lowest interest rate, the lowest cash to close, and the lowest mortgage payment. I mean, that's a given. But of those three factors, there's always something that is more important to you than anything else. We can probably afford a little bit more of a monthly mortgage payment, but we just don't have that much cash right now. We're cool, honestly. We're good with a $1,200 payment. That's not a big deal. That's fine. But we just can't really afford that. We just don't have that much cash put aside. Okay. Well, can you afford a $1,300 mortgage payment? Yeah, we can do that. Okay, so we can raise the interest rate, put you in a down payment assistance program, lower your cash to close greatly by having the down payment covered, and all of a sudden your $10,000 in cash to close went down to $4,000 cash to close. Wow, that sounds great. And the $1,200 to $1,300 a month doesn't necessarily matter at this point in time because you both you and your spouse feel very comfortable with that $100 increase. But man, the fact that you just saved $8,000 to get into a home, that works. Cool. And that's where these conversations come into play. Which loan program is best for you as a family? Which one makes the most sense to do what you want to do? And that's where these relationships come into play, is that we can help guide you to those decisions. That's sometimes people, they don't even realize that some of these options are out there. I can't tell you how many times we talk to people and they can get a gift. That some loan programs allow mom and dad to give a gift. To help them out. And that's a lot of the way I get gifts all the time, actually. So. All right. And then most important to you, cash close monthly payment interest rate. We're talking about that.
This is your
Excellent.
the breakdown of the payment.
And mortgage payment is broken down too. So it's PITI is a word you heard used often with mortgage payments. So principal obviously is the sales price of the home. Okay. So whatever that mortgage, your mortgage is. So that's the LT. There's a lot of acronyms in the mortgage world. So loan to value ratio. So your loan to value is, here's your sales price. We're going to use a round number. Let's say $100,000. So you have a $100,000 sales price home, and you want to put 3% down. So your loan to value ratio would be a 97. Does that make sense? You want to put 20% down at home. Your loan to value ratio is 80%. So then the 80% is your loan, because the other 20% is your down payment. So whatever your loan amount is, so that's what your principal is based off of. Okay, and then you have the interest rate, which is working the interest. So PI, so principal, interest, taxes. Taxes are property taxes. Property taxes are pretty easy to pull. Some people do estimates. We actually go straight to the county and pull the taxes. That way, we know exactly what those taxes are going to be. Literally, you can just go on the county and county tax assessor websites, pull the taxes, divide by 12, and that's what the tax payment's going to be. Now, taxes may change from year to year because of property value areas, property value assessments by the county. Specifically, let's say you bought a home, and let's say an elderly couple own the home that you're purchasing. They may have tax exemptions, and so those tax exemptions would apply to you within the first year, but then but if you didn't apply for some of those same exemptions, your tax would then go up the next year that you own the home. And we walk through all this stuff. Hey, by the way, your taxes are great, your monthly payment's going to be awesome, but if you don't have some exemptions that next year, then in that next year, it's going to jump up a little bit. And we always explain that. So people we call payment shock, just so you know about this. And then the next thing is insurance. So if you have mortgage insurance, and there's like a second I, there's PI, TI, but it's homeowner's insurance. That's where everyone's going to come in. Every home has to have insurance.
Yeah,
And a lot of people don't know that. A mortgage payment covers your principal, your interest, your taxes, and your insurance. It's all into one. And then if you have an FHA loan, or if you have a conventional loan that requires mortgage insurance, then it's all tucked into that as well too. So it's 5 things. So it's all paid at once. You don't pay separate people. It's all like your payment is one thing. So. And then what affects the interest rate and what affects mortgage insurance is these two right here. Your debt to income ratio and your credit score. They have a massive effect. And also your down payment size. These 3 factors here, how much money you're putting down, what your credit score is, and what your debt to income ratio is, they affect your mortgage insurance rate, they affect your interest rate. It really has a great effect. People have always often asked me, if there was one thing that is more important than anything else in the mortgage, like when you're going to buy a home, what is it? I have a ton of money. Cool. Your credit score. It's your credit score and your debts. It really is. It really offsets everything. Because if you, I can't tell you how many people say, I have a boatload of money, but you got bad credit. I have a boatload of money, but I have a ton of debts. Well, take that boatload of money, pay off your debts. But the reason why credit score is so important is because there are some things with a credit score that money can't solve. Money can't make let's say you all of a sudden make a ton of money for whatever reason, or somebody gave you a pile of cash. I can't make your 3 years of late payments go away that fast. It just can't. It just doesn't happen. Like credit scores need time for some of those things to float on. So pay your bills on time. Pay your bills on time. Make sure you're staying on top of collections. Your credit score is so vital to this process more than anything else.
Okay, so now we know why we work with Bart. He's amazing. Like, he will explain everything to you in great detail in a very short period of time. But he's awesome. That's why we
lots of caffeine helps.
Yeah, that's why we choose to work with him. So now that you are pre-approved and like Bart has gone through everything for you, the next part in the process is working with your agent. So the first thing you do after that, or sometimes before you work with your lender, is choosing a real estate professional that you trust. That is our goal, for you to trust us. We make sure that we take on any problems that might come up, because they always do. So our goal is that you don't feel those bumps, because there will always be bumps, but we try and make them as minimal as possible. You want someone to guide you through. Truly, some transactions are really easy to get through, but where the rubber hits the road is when you have issues. That's what we're there for. We consider ourselves project managers as far as like managing that transaction all the way through. We help you find the house, we work with the lender, we work with insurance, we work with closing attorneys. We get you to that closing table and put those keys in your hands. And then actually we stay in contact afterwards too to make sure that you're happy. Okay, so touching a little bit on what Bart had talked about, earnest money, down payment, and closing costs. So a lot of times people are unsure. Bart had mentioned what's the minimum that you could actually come to the table with, money in your pocket. So we're going to discuss them really briefly. So earnest money is what you put down when you make an offer. So on the house that you're offering sales price, generally it's 1 to 2% that you would put down of earnest money at the time you make the offer. So you're going to have that you have to have set aside. The other part is your down payment, which of course Bart talked about. So depending upon what that program is, just keep in mind that your earnest money goes towards your down payment. So if you're putting 5% down and you put 2% down of earnest money, that goes towards that. So you don't have to have that other 3%. It's not like I have to have 5% and 2%, so I have all this money I'm putting out. So there's that. A lot of people get confused about that and think they need way much more money than they actually need. Closing costs. We always estimate them to be roughly 3% when there is a lender involved of the purchase price of the home. So that is another part of the money that you have to be looking at. Now, depending upon your situation, it's possible sometimes to get the seller to contribute some or even all of your closing costs, again, based on the estimated 3%. So that's when Bart was mentioning that you may not need as much money as you think to even, come to the closing table. So it's important to know in the beginning where you need to be, so you don't have any surprises once you get into it.
And I think that's where the relationship part really comes in. I think that one of the things, so like I'm going to give you an example. So today is a Saturday, and I have probably 8 different people that are active buyers, and their agents that they can text me at any given time of the day, which we've done today. But about pulling addresses. So when I have an address in, we can check the taxes. We look at the numbers of the down payment of that specific client, what the sales price is, and then we pull numbers and we'll say, hey, cool, this is what your monthly payment would look like on this property. When you look at your close, because your close date has affected closing costs, but like that's where the relationship building really comes into play, is that we can say, you can be within less than 24 hours, we can bounce a couple addresses back and forth, and then all of a sudden, you have real, tangible estimate numbers that are pretty close, so you know what you're getting yourself into. And I think that's really where the relationship more than anything else comes is, like, we've all bought houses, and so we're not, like, it's a really stressful process. You're putting, money that you and your spouse and your partner have worked your entire lives for. It's a big decision. We really don't try not to take that for granted. And so for us, how do we calm you down? How do we get you to trust us, A? And then how do we get you to feel comfortable saying, you know what, okay, woo, let's jump off the cliff. And to do that, you need information. If somebody were to tell you, hey, you know what, there's no sharks in that water. It's clear, it's 25 feet deep, it's beautiful, there's no rocks. You go, great, let's do it.
I'm sitting here with a life preserver.
Yeah, life preserver, and then when you jump, there's somebody with a margaritas after you jump and you belly flop, you have a margarita and you're good. Cool, you're ready to go. Meaning, the more information that you have about what you're getting yourself into, then you feel more comfortable. And that's what we
Takes away the scariness.
Absolutely. It is a scary process. I remember when I signed the papers the first time, well, my wife basically signed the papers the first time, I just made sure the money was there. But it is a scary process. And so for us, by having this relationship, we can give you information that helps that takes the curtains back. And says, hey, boom, this is numbers. This is real. This is what this is going to be.
And
like.
you can do this.
Yeah. And you're like, okay, cool. Right? I mean, there's always been those decisions in life. And until you actually have real numbers, you're scared. And then now you see, this is what's actually really going to happen. Okay, cool, that makes sense. And that's what we want to do, is give you real numbers. And that's what this relationship can do. So.
Yep, absolutely. So the next piece of it, when you're working with an agent, you are not, again, spending hours on Zillow, going to tons of open houses. We're there to, we don't just open doors and show you the pretty house and, oh, look at this, and oh, look at the paint, and oh, great floors and all of that. I mean, there's a lot more to it when we get to it. We're looking in the areas where you say you want to live, whether it's school district, whether it's close to work, whatever it is, we're there to narrow down that search. And to when for me personally, I know when we're looking at a house with clients, clients walk in, they're excited. They see, they love the light fixture, or this master bedroom is huge. My job is to go in and actually look in at, that's a great master bedroom, but did you notice there's a huge, stain up here where there may be a leak from the roof or something going on with that, or, walking around outside, I might notice cracks in the foundation or drainage issues or that kind of thing. We're your eyes to kind of, see that for you, what you might not be seeing while you are falling in love. We're kind of showing you the, was it not the catfish thing? Just the pretty pictures are online, so then you actually see what they look like when you get there. That's what we see ourselves.
Instagram is a real thing with house pictures. They can be.
Yes, it's true. So then, when you found the home you want, so this is making the offer. This tips to success. This is again where we also are showing you how we help you. So determine your price. So your lender pre-approval, full approval, wherever you are in the process. We already know that by the time we get there. And the other reason you want that pre-approval is not just so you know what you can afford, but also so you understand that you're not looking at homes that maybe are above where you can be. Like you think, oh, I know I can afford a $400,000 house, and you look at the $400,000 house, and then you find out you can only afford the $250,000 house. There's a big difference there, so that's where that comes into. And then submitting the offer. We will discuss the comps in the neighborhood. We'll look at what's a fair sales price, to offer for that home. And then we're also talking about how we structure that offer. that is where we come into play with what's important to you, and when you're talking about your, not necessarily down payment, because by that point it should be decided, but when it comes to closing costs, do we want to ask for closing costs? What's important to you? We pay attention to what the market looks like. You know, we help set that up and negotiate that to put your best offer forward to get the house that you want. And it's what's tailored to what works for you. And then, of course, acting fast. Time is of the essence. Other reason to have that pre-approval before you even start looking. You can't even basically make an offer on a home unless you have a pre-approval, because they won't take your offer seriously. So you got to strike while the iron's hot. And that's also the reason we're out there too, is to tell you what the market looks like. Even micro, like, you know, sections of where you're looking. It depends. Some markets are like white hot, and you have to basically like really jump on it. And other ones you can kind of take your time, and that again comes into negotiation and how you're going to structure that deal.
Yeah. And that's, and going back, that's really the teamwork comes into play. I mean, there's, I'll give you 250 to 200,000 is probably one of the hottest price markets in the city everywhere. If it exists in some areas, where it doesn't, it's not. But yeah, exactly. But it's, you know, so that specific price point, I know somebody's at that price point. I highly encourage them to get all the documents to us beforehand, because we can close in 2 weeks. We can close in, as a big sign on the back says, we can close in 8 days if we need to, which most lenders can't do. And by being able to close fast, in the end, as a seller, what do you want more than anything else? Obviously, you want a buyer who's going to buy your home and get treated well. But in the end, you want to get paid. And you want the money. So whoever get the money to you the fastest is going to win the deal when there's 10 people. And that's where speed comes into play, is that if a listing agent calls me and says, hey, Sonny, give me your number. We have these clients that would like to purchase this home. We have 10 other people that want to do it. Tell me about why it happens all the time. Tell me why we should accept the offer. Well, first of all, these agents are awesome, and this is why. But second of all, these people are great. They have the money. They have employment. We checked everything out. I can close this home in 10 days. You can do what? Close this home in 10 days. Let's go. Boom, your offer's accepted.
Yeah,
Speed.
sometimes
I would say at least 50% of all the deals over the past 6 months have been because of speed. So that's why it's so important.
Yeah. So we kind of talked about some of this, the 5 reasons to work with a professional versus working on your own. You know, everybody thinks that, again, we just open doors and negotiate a deal. To be honest with you, the meat of all of this is a contract. If your contract is not right, it will hurt you in the end. And unfortunately for sale by owners, they don't always pay attention to that, and it hurts them in the end too. But on the buy side, when you are a buyer, that is the whole point. We want to make sure that you are protected in the end, and we can add special stipulations and you know, structure it so it is beneficial to you. And again, that contract, getting it to the closing table, and you know, making sure that we hit all your deadlines and all that too. So obviously our experience and negotiating for you, and then the pricing as far as figuring out what is a fair price to offer for a house. And then the market conditions, which we also discussed. I don't know if anybody knows Dave Ramsey, most people do, but basically, you know, we like this because they're basically, you know, it makes you understand why working with a good agent can help you. You know, we, again, working with our lender, we're going to help you find that home that fits in your budget. So this is really important for us as far as knowing the market. This is when you talk about what is a seller's market, what is a buyer's market? You know, what does that look like? Right now, we're actually in a seller's market. There's usually, in most markets, 3 months or less of inventory. And the trend is actually going further that direction. There's a lot of buyers out right now. Interest rates have been great, and the trend is only going to go that way. And the reason we point this out is that if you're considering it, we're going to show you a little bit more data on this, but if you're considering it, it's not going to get better, it's going to get harder to find a house, especially in certain price points. So this is the appreciation where it's expected to be as it's coming up, you know, 2020 through 2022, nothing less than 2%. And that again is housing, the prices going up year after year, and sitting and waiting is not to your benefit. again, the inventory declining, seller's market again, because it is such a rush right now, everybody's out looking. In fact, January, February has been more like, usually you hear about the spring market, starts in like April, May. It started in January this year.
It never ended.
And we knew this, yes, we knew this. So, this is existing home sales. Year-over-year increase. The South is actually the best market in the country. Which again, that kind of goes back to the whole, competition and times of the essence and working with an agent that you trust. And here's more specific. The United States is 5.4% for appreciation rate. Georgia is at 4.8%. So when we were talking before about how much money that you gain in equity when you buy within that 5 years, it was a little over $37,000. It's actually lower than what this shows it to be. So that's how much you're gaining in equity. Okay. So this is our cute little things to avoid 10 commandments of home loans, which is actually on the back of the flyer that you'll notice. It's kind of tongue-in-cheek, but it's also really serious. From the time you actually start the process, but especially once you're under contract, these are the things you do not want to do, because this is what protects you as far as, getting your earnest money back if you decide to terminate a contract, or, when your financing contingency comes up. And that's kind of getting into the weeds as far as like too much of, information. I know this is a lot that you're getting today.
Our job is to protect you.
Yes.
If you do these things, you make that job harder.
Don't hurt yourself. So this is 1 through 5. 6 through 10. So basically we're saying don't open a credit card, don't move money, don't co-sign a loan, don't,
We are your home buying Moses.
don't quit your job.
Okay? Let us guide you across the river safely. Okay? No, but some jokes, if people, these are kind of funny, and most people read these like, oh yeah, duh. But we would put these down if they weren't coming from live examples of how they weren't paying attention to. It's a really important thing. Sometimes people don't realize it's once you get under contract, all of your finances are heavily scrutinized, and doing anything to jerk them one way or the other can throw off debt, can throw off credit scores. It really can. There are so many different checks that our underwriting departments do with the federal government that literally look at everything you do. And so it's just, don't do these. Help us help you.
Basically, don't do anything when you're under contract unless you check with your loan officer. That's what we say. Don't do anything.
You don't have a car, take a bus for a month. Don't have a credit card.
Okay, so I know we're getting kind of long here, but we just want to a couple more to know when we talk about money to the table. 2 other items that you will have to pay for are your house inspection. You can buy a house without having an inspection, but I would definitely never recommend that because they are there to uncover things that you can't see. Really small details that you can't see. So that protects you. But as far as money, as far as how much it is, you're looking at about $350 to $450 on average for a home inspection. Very, very well worth the money, very, very recommended. The other part is the appraisal, which is necessary for the lender because they want to make sure that the home that you're purchasing is actually worth what you've offered to pay for it. And that is usually between $550 and $650, again, on average. And I don't know, are there some times when that can be rolled into the loan, depending on the program?
It's always paid up front, but if the seller is paying for all the closing costs, the appraisal is considered part of the closing costs, so then that money gets backed out. So it will get, the seller is paying for it, even though you're paying for it up front, it gets reduced from the closing costs, the cash to close. And so inadvertently, in the reverse, and you'll see it in the closing statement, you'll see that even though you paid for it up front, the seller actually paid for it. So you can get that. It would just that money is less money you can bring to the table.
Right.
But and it's, in appraisal, as I tell people, appraisal, it's really, people think these are the same thing. So very simply, this is the value of your home. So this is more aesthetics and the way the home looks and is a livable, safe thing, house. Inspection is behind the walls. HVAC, plumbing, stuff that you can't see. we don't really care about the inspection as a lender, because for us, we are looking as a lender, we're looking at the individual, this person be financed, and is the property a financeable property? And the reason is simple as this: if we land on a home and it's not it's not an appraisable, great value home, and there's foundation issues with it, things that would affect the value of the home, then when you get under contract, those things, or you close the deal, all of a sudden you're in a home with a loan that we did. And then the property starts falling apart because we didn't do these things. And then all of a sudden, all that money that we thought you had that was stable for you to continue to pay your mortgage, it's going to fix the home because it's falling apart. So that's why it's so important that we, not only do we review the property, but we review the person's finances.
Right. So contract to close. Again, a lot of this is just kind of touching on this again, getting to the closing table. That's where we come in and there's a transaction. We make sure we're paying attention to the hard dates of due diligence, your appraisal contingency and financing contingency. Of course, that's something we can discuss further at a point. The homeowner's insurance and what's covered, and Evan's going to touch on that briefly. I know Bart spoke about debt-to-income ratio and how that comes into play with not just your pre-approval, the loan itself, but how that your mortgage payment comes into play. And then your mortgage insurance, which is part of that. And now, we're going to bring that.
Cool. That's me. Hey guys, so my bit is going to be kind of shorter. Really, I'm just going to kind of give you the highlights of my company and kind of what you're going to expect when you work with Bart and you work with Sonny and Joe. We kind of come as a package deal, as I'm sure you guys have figured out. And then really, I'm just going to explain the point of my company's existence and really what we are here to do when it comes to your first-time home buying experience. So, I'm going to talk about the 3 points of protection that my company really designs around, why we exist and what our motive is as a company. And then those 3 are homeowners / condo insurance, depending on what you buy. If you're buying an attached townhome where the exterior and the roof are covered by an HOA policy, you're just going to need a policy on the interior. That's what condo insurance is. Homeowners is basically a single-family detached home. The policy is responsible for anything that happens to the home or the structure on it. Next thing, auto insurance, something everybody legally by law has to have, fortunately but unfortunately. And then life insurance as well. I'll touch on that and why that's an important factor when buying a home as well. Kind of what we do to help you mitigate that risk as you're moving through this process. So if we jump over to the next slide here, we've got a little snippet of kind of what my life looks like when it comes to what I'm doing. I'm lucky because I get to do a whole lot less paperwork than these guys do and that Bart does, but the little bit of paperwork that I do is very important, okay? When you're talking about putting together a homeowner's policy, really the most important thing that I'm doing is I'm making sure I can rebuild your home at the right amount, okay? Because what you don't want to pay for a policy that costs way more than you should be buying. If you have a house that costs $200,000 to reconstruct, you don't want a policy that has $280,000 in coverage because you're eventually you're wasting money. So a lot of people think there's a misconception of, hey, I have a $200,000 house, but my policy's got $300,000 in coverage. If my house burns down, I'm just going to trick out my house and have $300,000. It's not how it works. The state mandates that you build the home back exactly how it was before it burned down on like, time, and quality. That's basically the whole principle of insurance. My job is to not make you better when something happens. That's called insurance fraud. My job and my responsibility is to make you whole again. That's the reason insurance exists. It's not to benefit you, it's to make sure you're whole again. So that's basically how the whole process works. It does benefit you to become whole again, though. It's not a benefit if you don't have anything left over. So this is kind of what I do typically whenever we're moving through a process of building a homeowner's policy, which is what we lead with when we're working with these guys in a transaction. So my job is to go in. Typically there's a listing that has a whole bunch of photos that really allows me to look in depth at what I need to look at. Sometimes I'll drive out to the house depending on the risk, and if I don't have information that I can't find, I'll drive out there and find it. I don't mind doing that because ultimately I want to make sure the customer's taken care of. So we're going to look through photos, obviously listing data. Sometimes you should trust Zillow with that, sometimes you shouldn't. That's why I look into the county records, because a lot of people like to put square footage of the basement on there, in different spots, and you got to make sure that it's being accounted for properly. So on the right here, you see a sketch of the home in the county records. So the county records are going to tell me everything that I need to know about this property. And the reason I'm doing that is because in my simulator, I have a simulator like he's got a credit simulator. I know you guys use variations of different things for comps and stuff like that, make sure the home is priced properly. For me, I basically know how much it's going to cost to rebuild this home based on the information I tell the system. So I'm not a builder, I don't build homes, I do insurance, but I can tell a system that can tell me how much it's going to cost to build a home. So it's important that information is correct and not overlooked, and that you know, the thing about these 1-800 companies, you call them up and say, hey, I need a homeowner's policy. In 5 minutes, they take the square footage and multiply it by 100 and say, oh yeah, 2,100 square feet, 210,000, you're good. It's not always the case because there's a whole lot more that goes into it. So we can jump on over to the next slide. Bundling matters. So this is something that you hear on commercials every single day, probably about 5 times a day. What does bundling mean? It basically means that you take your homeowner's insurance and you place it in the same company that you have your auto insurance with, vice versa. The whole reason for that is when you're a company, such as Travelers or Nationwide or all these people, they're saying, hey, we'll take your business, but we'll give you a better rate if you give us all of your business, because that means it's more money in our pocket, which is basically how that works. Insurance companies aren't in it for charity, so in order for them to get more, they're going to give you more, which is savings. So bundling doesn't always work because you may be really high at a company with auto insurance, but really low in homeowners, and vice versa. And it may make sense to split it, but most of the time bundling does matter. So when the transaction happens to, Sonny and Joe and Bart send over a deal to me and they're like, hey, we need insurance on this one. One of the first things we're going to talk about is bundling. And so the main reason for that is debt to income. It's a big issue sometimes when you have, debt to income that's really close to that 45 or 55% depending on the loan. Homeowner's insurance, as he mentioned earlier, is included in your payment. So what is one thing we can do to get your homeowner's insurance down? Bundling. 20 to 30% is typically the discount for bundling, things like that. Sometimes you may have to take a hit on your auto insurance with a certain company in order to close on that house, because if your ratios aren't at a certain point, then you're not going to be able to close anyway because we've got to get your homeowners down. So those are some types of things that bundling can help with. Also, all around it's always better because you're typically going to save money, especially with the competitive carriers that I carry. So that's just a little hit on that and kind of explaining what bundling is. And I think I got one more slide up here, and this is really on the life insurance piece. So we talked about homeowners insurance. I could teach a whole class on exactly how it works. Basically, the gist of it is know that we know what we're doing, and we're going to take care of you and get you a policy that's right for you. We're going to try to bundle and make everything better as a whole. And probably the most important piece of what I do is your life insurance. Okay, so when you guys purchase a home, you're basically buying the most expensive thing that you're ever going to buy in your entire life. Okay, let's say depending on the situation, you have a spouse that has most of the income and a spouse that has no income or little income, or it's equally spread. Every family is different. The reason you have life insurance is to make sure your family can stay in that home if something happens to you. So my company is specifically designed to start with a homeowner's policy because that's where people come into my door. That's when I like dealing with people that are going through something that I can help make that transition better for them. That's why I lead with homeowners. I love working with realtors. I love working with mortgage lenders. So we start with the home, get them taken care of, and then I can start putting all the pieces together to their whole insurance picture, because your life is not just a home. It's not just a car. It's not just your kids. It's a combination of all of those things. What I like to do is, sort of help put all the pieces together and get everything going as far as, whole holistic structure. That's what we based our company off of. So once we get your homeowner's insurance right, once we get your auto insurance in place and get it with the right company that you should be with, save you the amount of money you need to save, that sort of stuff, the final piece we're going to look at is life insurance. And something that nobody likes to think about. It's something that nobody likes to go through, but it's something that we make super easy for our clients. So this is actually a screenshot from my website. This link is always sent in every deal. Hey, I don't know if you have life insurance. I know you probably have some through work, but here's something that you can make sure your family's protected on. We're protecting your home, we're protecting you as well. So basically, this is the suite that I have set up through my website. Someone can go in about 5 minutes, have a policy. Obviously, they've got to do the underwriting requirements that's required. Sometimes it's blood work, sometimes it's just an exam over the phone, a lifestyle exam. It totally differs. But this is just kind of a peek into what we do, how easy we try to make it for clients to make sure they have the proper protection. Because the last thing some people want to talk about is insurance, and my job is just to be here, be a part of this team, and really help you make sure your entire life is protected. And I want to be standing behind you as you go through the years and things change in your life. We want to make sure we protect you. So, do you guys have any questions for me regarding insurance in any realm at all? Cool. Well, that's pretty much all I got. I don't know if you guys got like a closing thing. Cool.
Yeah, just.
Thank you, guys.
That's okay. So we're actually wrapping this up now. I hope that we provided some, actually, I know we provided a lot of information, but I hope we provided good information for you. It was a little bit like drinking from a fire hose. There's a lot that we throw out. But we didn't even get into the like the depths of what we could, to be honest. So with that being said, we would definitely like to talk to anybody afterward who may have additional questions, maybe even ready to get started. We are not pushing in any way. We are here to help you. If it's something you're thinking about now, great. If it's something you're thinking, maybe I want to wait a year, great, there too. We're happy to give you information as we go along, and it's good actually to get started with a lender and kind of see where you're at. So maybe you're not ready now, but in a year, if you have already been speaking with someone and you kind of know what you need to do to set yourself up, you're going to be in a lot better position and probably be able to afford a lot nicer home in that year when you're ready.
Mm-hmm.
So that's one of the other reasons we're here too, is we don't want this to be just transactional. This is a relationship for us with the people that we meet and with your friends and family.
Most people will buy 3 to 4 houses in their average of their lifespan. So, for us, I think that I like first-time home buyers because on a pure business sense, it's if we do a great job for you, then hopefully we'll continue to do multiple properties for you during the life of that home buying career. And I think that for us, as I constantly say, Sonny Joe, the biggest thing is it the most important thing for us to get you everything that you want? Of course, but the most important thing for me more than anything else is that when on the day that you get keys to your new home, that you feel informed, and you feel educated, and you feel that you fully understand everything that you're getting yourself into, because that builds confidence. And for me, I think for us, that's more important than anything else. Is that you feel that it's been a trustworthy process, and that there's nobody hiding anything from you. So.
Yeah, great. So we'll wrap up the video right now. So I just want to thank you for attending. I want to thank Bart and Evan for joining us here today. Again, our team that we definitely won't like to present ourselves that way because we do work that way.
Absolutely. Again, we welcome any questions. Obviously, after today, we're always available if you need anything from us. And again, we are presenting ourselves as a team, like everybody said, it's transactional. We want, or not transactional, it's relationship. We want to